Nearly half of Canadians are living paycheck to paycheck. Millions say they're just $200 away from not covering their monthly bills. In one of the wealthiest countries on earth, families are skipping meals, delaying rent, and choosing between gas and groceries. How did we get here? How does a country known for stability and opportunity suddenly feel financially fragile? This isn't just about inflation. It's not just about high rent. Something bigger is happening beneath the surface. Mortgage payments are resetting at higher rates. Grocery bills are climbing faster than wages. Credit card balances are hitting record highs. Quietly, household debt has become one of the highest in the world. The pressure is building, and many people feel it. So what's really going on? Today, we're breaking down the 10 real reasons why so many Canadians can't afford basic living costs, and what this means for the future. Number 1. Housing crisis. Across Canada, housing has quietly become the single biggest financial pressure crushing households. Over the past decade, home prices surged far beyond income growth, turning what used to be a normal life milestone into something that feels almost unreachable. Even renters are feeling the squeeze. In many major cities, average rents have jumped hundreds of dollars in just a few years. For families, that means one thing: a larger chunk of their paycheck disappears the moment rent or mortgage is due. When over 40 or 50% of income goes towards shelter, there's little left for groceries, savings, or emergencies. Meanwhile, homeowners who locked in low interest rates during the pandemic are now facing a harsh reality. As mortgages renew at much higher rates, monthly payments are rising dramatically. A family that once managed comfortably may now be scrambling to cover an extra few $100s each month. First-time buyers are stretched thin, often taking on massive debt just to enter the market. Investors and limited housing supply have added even more upward pressure, creating bidding wars that push prices beyond logic. For many, the dream of owning a home now feels like a financial trap rather than a foundation for stability. On top of that, population growth and slow construction have created a serious supply-demand imbalance. Simply put, there aren't enough homes for the number of people who need them. This imbalance drives competition, raises prices, and keeps rents elevated. When shelter costs rise faster than wages, households compensate by cutting essentials or increasing debt. And once housing eats up most of your income, financial stress becomes constant, unavoidable, and exhausting. If housing costs are hitting you hardest, tell us what changes you've seen in your city, and subscribe to support the work we put into breaking this down for you. Number 2. Inflation surge. Every trip to the grocery store now feels like a reality check. Prices that once seemed normal have quietly climbed week after week, turning basic necessities into budget-breaking expenses. Milk, bread, eggs, cooking oil, items people buy without thinking, now cost noticeably more. Even worse, many packages are shrinking while prices stay the same, a practice often called shrinkflation. For families already stretched by housing costs, these increases create constant pressure. When food inflation rises faster than wages, households don't just feel inconvenience. They feel instability. Beyond groceries, fuel, and utility bills have also added to the strain. Gas prices fluctuate sharply, making commuting unpredictable and expensive. Heating and electricity costs rise during peak seasons, leaving families anxious every time they open a bill. Inflation affects everything from childcare to car repairs, and these aren't optional expenses. When everyday essentials cost more, people turn to credit cards just to maintain their standard of living. Over time, this creates a dangerous cycle where short-term survival leads to long-term debt. What used to be manageable monthly costs are now becoming financial tipping points. At the same time, wages simply haven't kept pace with rising consumer prices. Even if someone receives a small raise, inflation often cancels it out. This means real purchasing power declines, even if paychecks look slightly bigger on paper. The result is subtle but powerful. Households slowly lose financial breathing room. Inflation doesn't feel dramatic overnight, but month after month, it erodes savings, increases stress, and makes basic living feel unaffordable. Are rising grocery or fuel costs affecting you more? Share your experience below, and subscribe with one click to support the effort behind these deep dives. Number 3. Stagnant wages. For many Canadians, the most frustrating part of this crisis isn't just rising prices, it's the feeling that their income hasn't truly moved in years. On paper, salaries may have increased slightly, but once you adjust for inflation, many workers are barely ahead or even falling behind. A 2 or 3% raise sounds encouraging until groceries, rent, and utilities rise even faster. What feels like progress quickly turns into survival. People are working just as hard, sometimes harder, yet their purchasing power continues to shrink. At the same time, productivity in many sectors has increased significantly over the past decades. Companies are generating higher revenues, technology has improved efficiency, and workers are producing more output than ever before. However, those gains haven't always translated into meaningful wage growth for average employees. Contract jobs, part-time roles, and gig work have replaced many stable, full-time positions with benefits. This shift creates income uncertainty, making it harder for households to plan long-term. When income becomes unpredictable, even small, unexpected expenses can cause financial chaos. As a result, many families rely on overtime, side hustles, or credit just to maintain a middle-class lifestyle. Saving for retirement, buying a home, or building an emergency fund starts to feel unrealistic. The gap between earnings and living costs widens quietly each year, creating a sense of constant financial tension. Without strong wage growth, everything else becomes harder to manage, no matter how carefully someone budgets. Have your wages kept up with your cost of living? Tell us below, and subscribe with one click to support the research and effort behind these videos. Number 4. Record household debt. Across the country, household debt has reached levels that would have seemed unimaginable a generation ago. Canadians now carry some of the highest debt-to-income ratios in the developed world. Credit cards, personal loans, car payments, lines of credit, they all add up quietly. At first, borrowing feels manageable, even helpful. It smooths over tight months and covers emergencies. But when balances grow faster than they're paid down, debt stops being a tool and starts becoming a trap. Meanwhile, low interest rates over the past decade made borrowing feel cheap and accessible. Many households took on larger mortgages, financed vehicles, or relied heavily on credit to maintain their lifestyle. The problem is that debt doesn't disappear when times get tough. As interest rates rise, minimum payments increase, and suddenly what once felt affordable becomes overwhelming. A credit card balance that seems small can snowball quickly under high interest. For families already stretched by housing and inflation, debt payments eat away at what little flexibility remains. As a result, more Canadians are finding themselves juggling bills, transferring balances, or using one form of credit to pay off another. This creates a cycle that's difficult to escape. The stress isn't just financial, it's emotional. Constantly worrying about payments affects sleep, relationships, and mental health. When debt becomes a permanent part of monthly budgeting, long-term goals like saving or investing get pushed aside. And that's when financial fragility turns into financial crisis. Are you seeing debt levels rise around you or in your own life? Share your thoughts below and subscribe with one click to support the work behind these breakdowns. Number 5. Rising interest rates. Over the past few years, interest rates have climbed at one of the fastest paces in decades. What once felt like an era of cheap borrowing has abruptly ended. Central banks raised rates to fight inflation, but the ripple effects have hit households hard. Loans that were affordable at low rates suddenly became expensive. For many Canadians, this shift didn't just increase costs. It completely changed their monthly budgets. For homeowners, the impact has been especially severe. Variable-rate mortgages saw payments jump almost immediately, while those with fixed rates now face renewal at much higher levels. A mortgage that once felt comfortable can now demand hundreds, sometimes even thousands, of extra dollars per year. Car loans and personal loans have also become more costly. Even credit card interest rates have remained high, compounding balances faster than people can pay them down. When borrowing costs rise across the board, financial pressure builds quickly and quietly. At the same time, higher rates affect more than just loans. Businesses face higher financing costs, which can slow hiring and investment. That creates uncertainty in the job market adding another layer of anxiety for families already stretched thin. The combined effect is powerful: higher payments, tighter budgets, and less economic confidence. When interest rates rise, every dollar borrowed becomes heavier to carry. Have higher interest rates changed your monthly payments? Let us know in the comments, and subscribe with one click to support the effort behind these in-depth videos. Number 6. Heavy tax burden. Beyond rising prices and debt, many Canadians feel squeezed by the amount of income that disappears before it even reaches their bank account. Federal and provincial income taxes, payroll deductions, and sales taxes quietly reduce take-home pay. On paper, salaries may look decent, but after deductions for income tax, employment insurance, and pension contributions, the number that actually lands in your account can feel disappointing. For middle-income households especially, this gap between gross income and net income creates constant pressure. At the same time, so-called bracket creep adds another layer to the problem. When wages increase slightly due to inflation, workers can move into higher tax brackets without truly becoming wealthier in real terms. This means a raise doesn't always translate into meaningful extra spending power. Add consumption taxes on everyday purchases, property taxes for homeowners, fuel taxes, and various service fees, and the cumulative effect becomes significant. Many families don't notice each individual deduction, but together they reduce financial flexibility month after month. As a result, households often feel like they are running on a treadmill, earning more but keeping little of it. This doesn't necessarily mean taxes are inherently bad, as they fund essential public services. However, when combined with high living costs, even moderate tax burdens can feel overwhelming. The real issue is balance. When expenses rise and disposable income shrinks, people feel financially stuck despite working hard. Do you feel your take-home pay reflects the work you put in? Share your thoughts below, and subscribe with one click to support the research behind these deep financial breakdowns. Number 7. Population pressure. Over the past few years, Canada's population has grown at one of the fastest rates in the developed world. Immigration plays a vital role in economic growth, filling labor shortages and supporting long-term demographics. However, rapid population increases can create short-term pressure when infrastructure and housing supply fail to keep up. When more people are competing for the same number of apartments, homes, and services, prices naturally rise. The result is tighter rental markets, longer wait lists, and bidding wars that push costs beyond what many families can afford. At the same time, public services and infrastructure require time and investment to expand. Schools become more crowded, healthcare systems experience longer wait times, and public transportation strains under heavier demand. While newcomers contribute to the economy, the adjustment period can expose supply gaps that drive living costs higher. Housing construction has not matched the pace of population growth in many regions, creating an imbalance that keeps rents elevated and home prices under pressure. When supply lags behind demand, affordability declines quickly. As a result, both newcomers and longtime residents feel the financial squeeze. Increased competition doesn't just affect housing, it can influence job markets and wages in certain sectors as well. The issue is not population growth itself, but whether economic planning keeps up with it. When growth outpaces preparation, everyday Canadians experience the consequences in their monthly budgets. Have you noticed population growth affecting housing or services in your area? Share your experience below, and subscribe with one click to support the effort behind these detailed analyses. Number 8. Healthcare and insurance costs. Although Canada has a publicly funded healthcare system, many essential services still come out of pocket. Prescription medications, dental care, vision treatment, physiotherapy, and mental health services are often only partially covered or not covered at all. For families without strong employer benefits, these expenses can add up quickly. A single dental procedure or unexpected prescription refill can strain an already tight monthly budget. Even small recurring health costs slowly chip away at savings, especially for seniors and low-income households. Meanwhile, insurance premiums have been steadily rising. Auto insurance, home insurance, and private health coverage are becoming more expensive year after year. Climate-related damages, higher repair costs, and increased claims have pushed insurers to adjust pricing upward. For many households, these increases feel unavoidable. Insurance is necessary protection, but becomes yet another bill competing with rent, groceries, and utilities. When premiums climb while wages remain stagnant, families are forced to cut back elsewhere. As a result, financial vulnerability increases. People may delay medical appointments, skip dental visits, or reduce coverage to save money. These short-term decisions can lead to bigger health and financial problems later. The challenge isn't just the size of one bill, but the accumulation of many rising costs happening at once. When healthcare and insurance expenses quietly grow in the background, they contribute significantly to the overall feeling of being financially stretched. Have rising insurance or medical costs affected your budget? Share your experience below and subscribe with one click to support the effort behind these in-depth financial breakdowns. Number 9. Corporate concentration. In Canada, a small number of large corporations dominate key industries, especially groceries, telecommunications, and banking. When only a handful of major players control most of the market, competition becomes limited. With fewer competitors pushing prices down, companies have greater power to set prices higher. For everyday consumers, this often means paying more for basic goods and essential services. Grocery chains, for example, operate under a few large parent companies, which reduces pricing pressure and leaves shoppers with fewer affordable alternatives. At the same time, limited competition can slow innovation and reduce consumer choice. If switching providers doesn't result in significant savings, households feel trapped. Internet and phone bills remain high compared to many other countries. Banking fees, account charges, and service costs continue to add up quietly in monthly statements. Individually, these costs may not seem dramatic, but together they contribute to the overall financial squeeze many Canadians experience. When markets lack strong competition, consumers often carry the burden. As a result, everyday expenses stay elevated even when broader inflation slows down. Essential services remain costly because structural market dynamics keep pricing power concentrated at the top. This doesn't mean businesses shouldn't make profits, but when industries become too consolidated, affordability suffers. Over time, households feel like they are constantly paying a premium simply because there are limited alternatives available. Do you feel like certain services cost more than they should? Share your thoughts below and subscribe with one click to support the research and effort behind these detailed financial insights. Number 10. Job insecurity. In today's economy, stability feels harder to find than ever before. Layoffs in technology, retail, media, and even parts of the public sector have made headlines repeatedly. Even workers who remain employed often feel uncertain about the future. Companies are cutting costs, automating roles, or shifting to contract-based hiring models. That means fewer permanent positions with benefits and more temporary or gig-based work. When income becomes unpredictable, financial planning becomes almost impossible. At the same time, the rise of automation and artificial intelligence is quietly reshaping the labor market. Certain repetitive or administrative roles are being replaced or reduced, while new positions require advanced technical skills. Workers who don't have time or money to retrain can feel stuck. Younger professionals face short-term contracts, while older employees worry about restructuring or early retirement. This uncertainty creates hesitation. People delay major purchases, avoid investments, and hold back from long-term commitments because they simply don't know what comes next. As a result, even those who are currently employed may feel financially anxious. Without job security, it's difficult to build emergency savings or confidently take on responsibilities like mortgages or family expenses. One unexpected layoff can quickly lead to missed payments and mounting debt. In an economy where employment feels fragile, households live in a constant state of caution. And when confidence declines, financial pressure increases across the board. Do you feel secure in your job right now? Share your thoughts below and subscribe with one click to support the work behind these in-depth economic breakdowns. When you step back and look at the full picture, it becomes clear that Canada isn't collapsing overnight, but many Canadians are being slowly squeezed from every direction. Housing costs are rising. Groceries are more expensive. Wages aren't keeping up. Debt is heavier. Interest rates are higher. Taxes, insurance, and everyday bills quietly eat away at income. Add job uncertainty to the mix, and it's no surprise that millions feel financially stretched. This isn't about one bad decision or one single policy. It's a combination of structural pressures hitting households all at once. What makes this situation more challenging is how gradual it feels. There's no dramatic crash for most people, just a steady tightening. A little more for rent, a little more for food, a slightly higher payment here, a new fee there. Over time, those small increases compound into serious financial stress. Families who once felt stable now feel vulnerable. And when financial breathing room disappears, even minor emergencies can trigger major consequences. But awareness is powerful. Understanding these 10 forces gives you clarity. It allows you to plan smarter, question policies, adjust spending, and prepare for uncertainty. Canada may still be wealthy on paper, but real financial health depends on whether everyday citizens can afford basic living costs. The conversation needs to happen, and it starts with being informed. If this breakdown opened your eyes, tell us which of these 10 reasons is affecting you the most. Watch our previous video for deeper financial strategies and support the work we do by subscribing. It's just one click, but it means everything to us.